Good afternoon. This is Ken at Tortoise Capital with a review of the weekend trading reports for March 10th, 2018. We have markets in bullish normal conditions. This should read bullish normal, sorry. On an annual basis, looking at weekly RSI 14, we are in the high end of neutral at 61 out of 100. Using the 10-day X closing near a 10-day high, we are deeply overbought at 100 on the 10-day NDX. In the market mosaic, price relative to the 200-day moving average is white bullish at 8.51. The slope of the 50-day moving average improved to yellow neutral at 0.3. The risk index is the 30-period moving average of the VIX divided by the 10-period. The boundary between risk on and risk off is 1.0. That score is 1.126, so we are well into risk on. Looking back the last 5,000 trading days, we find the average and standard deviation to compute the risk Z, which is 1.31. That means we are 1.31 standard deviations above the long-term average for that indicator. This is a 90-day histogram of that indicator, and you can see that the big sell-off has recovered in terms of volatility, and this has been favoring the swing trade on the long side for about the last 10 days. For those of you following along in the swing course, you know that that has been a good payoff for us. These are the holdings for March, and the current leaders based on prices on Friday. The theoretical exposure is 50% inside the ETF2. The blended monthly rebalancing portfolios, just taking a quick look here, real strength in technology and emerging markets and the Russell, so that's reflective of the risk on categorization. In the ETF 32 portfolio, again, technology, emerging markets, industrials have really been doing well inside the U.S. And the Russell, of course, is doing well. In the Dow 30, Intel, Caterpillar, that's technology and the industrials. DuPont, also industrials. And McDonald's is recovering from its deep sell-off. So maybe that's the first of these bottom five that's turning around. So we will continue to stock and trade that one to the long side. It's Dow 30. Sector spiders, 3/4 are on buy signals. Energy, home builders, real estate, treasuries, utilities, the defensive plays, if you will, are suffering. Gains in capital markets, healthcare, transportation, telecom. In ETF Max, you can see the real winners have stepped up and been dominating here in, let's see, cocoa, the internet, small cap healthcare, semis, so still a strong representation from technology here. This is the market health check. Vertical blue lines are 10, 20, and 30 days worth of look back. The horizontal red lines are support levels that used to be resistance. We broke through the target resistance here at 275.5. And then the next one is the previous swing high based on the dragon hump here at looks like 284 is in sight. The slope of the 10-period regression channel is up. The 30 is improving. You notice it has come down, bottomed out, and now is when it gets across this dash line, then that will have tipped favorably. The MACD histogram and PPO has been marking the steady improvement in the market here since the big sell-off, where it began to the slope began to improve here, crossed the 5-period moving average here, entered the river, crossed the zero line once, pause, and a second time, and continuing to improve. So that's all favoring the upside very much. I want you to just notice the low and the higher low here in the baby dragon. That's all favorable. And you see it reflected also in the dragon itself here, and then here also. The the regional summaries, 70 and 37 of these indexes are on buy signals, 3 are on cash. Strength in technology and discretionary, and the industrials have been coming along well. Weakness in staples and utilities. Mixed bag in the U.S., large cap and technology really leading the way. Latin America and Brazil still looking good. Canada, Mexico lagging in the Western Hemisphere. Mixed bag again in Asia. Looking at the ETF top 30 through that lens, through the ETF2. Technology, green and white, is bringing strength to the market. So it's paired here with the Qs. Brazil, metals and mining, still at the top. Shifting to the daily now. No signals in channeling and overreaction. Max Pain candidates remain some of the same names that we've seen before. Boeing, Disney, Walmart, Nike, ExxonMobil. 10-day Max Pains. Lowe's, Targets, General Motors, Qualcomm. Lots of things to choose from in the auto framer. You saw Friday's big mover day featured strength in Caterpillar, GE, Chevron, and Intel. Caterpillar and Intel would remain my momentum plays. Looking for continuations on Monday. And VIX got really crushed on Friday. Again, a handful of auto framers, better than 2 to 1. The lack of dojis just tells you how broad-based the gains were, and you can see that NASDAQ 100 and the S&P technology just really dominating. Russell small caps too, so that's really risk on. In the pinch and stretch report, notice the Russell has really been the leading index inside the U.S., taking over that leadership from the diamonds. Intel, Tech, Cisco, Microsoft, small caps, Apple, seeing the pattern error in technology. Laggards. Walmart, McDonald's. So McDonald's is still interesting because it has that had a really good 1 week performance. So we'll be looking at that. So Intel, Caterpillar, XLK, the Qs. These are all symbols that I'm going to be working up my trade frames on. Mechanical entry framework for the auto framer. Lots to choose from again. And in the regression line fractal framework, the top shelf are the deeply discounted plays, the number that are the greatest number of average true ranges below their long-term fair value. So McDonald's, Procter & Gamble, Walmart, ExxonMobil, Johnson & Johnson. You see the domination of technology on the ones that may be overheated, the symbols that are the most number of ATRs above their RL270 by symbol population. No squeezes per se. A decisive vote up on Friday and to hold that position overnight. The slope of the 30 has gotten back to the long-term average. Correction, that's the zero line, my bad. And that would be the long-term average. So still a little bit more room to go. But this often marks a turning point when you see the crossover more than a standard deviation away from the average, and that's what we had here. Recovery nicely in a historical context. Volatility coming out of the market continuously. Looking at the 3 RLs and their slopes, the 10 made this nice rebound, tactical pause, and has recovered nicely. The 30 has now resumed. The 90 remaining comfortably in the bull. And we've reached the far side of the river now. We'll see if this will maintain and beyond. And now the next thing is a test of 285. All right, that's everything I want to cover for the weekend report. This is Ken at Tortoise Capital. Keep your risks measured and your powder dry. Still time to join the advanced swing trade course. We had a new group starting in on the first week of March, so still time to get on board. Thanks for your kind attention.